So Warren Buffett just shared his thoughts on the stock market today and what he sees coming in the next few months. In this, he made some major changes to his previous comments. And that's why in this video, we're going to hear from Warren Buffett and break down his thoughts. So on this channel, I usually focus on investing in innovation, whether that's cryptocurrency, genomics, or artificial intelligence. But today, we're going to hear from arguably the greatest investor of all time, Warren Buffett. And while he's not exactly renowned for investing in innovation, what he shares in these clips will affect every single investor and company out there. So even if you're only invested in innovation, this will impact you too. But with all of that said, let's jump into this first clip where Warren Buffett is asked his thoughts on the high stock prices of technology companies such as Apple today.
But I don't regard prices, and that gets back, it gets back to something fundamental in investments. I mean, interest rates, basically are to the value of assets what gravity is to matter, essentially. And on the way out here, I tore out a little clipping from the Wall Street Journal yesterday. Probably the only one that read it. It's so small, I'm having trouble finding it. But anyway, yes, on Thursday, the U.S. Treasury sold some 4-week notes, Treasury bills, and the price was if you looked at your Wall Street Journal down a little corner next to the last page in my paper, in the very bottom corner, here it is, the results of the Treasury auction, little tiny thing. They had applications on the 4-week Treasury bill for 100 and some billion. They accepted bids for 43 billion worth. And it says average price 100.0000000, 6 zeros. And essentially, people were giving 40-some billion dollars to the Treasury, and they offered to give 130 billion or something, whatever the amount tendered. And the Treasury received the money at zero. And Janet Yellen has talked a couple of times about the reduced carrying cost of the debt. I think in the last fiscal quarter, the U.S. Treasury, the U.S. government, which owes a few trillion dollars, I should say, a few trillion dollars more than a year ago, their interest expense was down 8%. So you've had this incredible reduction in the so-called super risk-free group, the short-term Treasury bill. And that is the yardstick against which other values are measured. I mean, if I could reduce gravity's pull by about 80%, I mean, I'd be in the Tokyo Olympics jumping. And essentially, if interest rates were 10%, valuations are much. So you've had this incredible change in the valuation of everything that produces money, because the risk-free rate produces really short enough. Right now, nothing. If present rates were destined to be appropriate, if the 10 years should really be at the price it is, those companies that the fellow mentioned in his question, they're bargain. I mean, they have the ability to deliver cash at a rate that's, if you discount it back, and you're discounting at present interest rates, stocks are very, very cheap. Now the question is what interest rates do over time. But there's a view of what interest rates will be based in the yield curve out to 30 years and so on. It's a fascinating time. We've never really seen what shoveling money in on the basis that we're doing it on a fiscal basis while following a monetary policy of something close to zero interest rates, and it is enormously pleasant. But in economics, there's one thing always to remember: you can never do one thing. you always have to say, and then what? And we're sending out huge sums. I mean, the president said it on Wednesday, 85% of the people we're going to get a $1,400 check, or 85%. And a couple of years ago, we were saying 40% of the people never could come up with $400 of cash. So we've got 85% of the people getting those sums. And so far, we've had no unpleasant consequences from it. I mean, people feel better. The people who get the money feel better. And people who are lending money don't feel very good. But it causes stocks to go up. It causes business to flourish. It causes an electorate to be happy. And we'll see if it causes anything else. And if it doesn't cause anything else, you can count on it continuing in a very big way.
So Buffett says that stocks today are actually very cheap. Now, to understand why he thinks this, let's use these two glasses of juice as our example. This glass, which is quite full, represents stocks. If you put your money into stocks, this is going to be the average return on your money per year. In the US, it's historically been around about 7% after inflation. Now, this glass represents bonds. As we can see, the return is anemically low at the moment. In fact, some bonds globally are even offering negative rates, which means you pay someone else to lend them your money. Now, to keep things simple, let's assume you can only put your money into these two glasses. For now, let's ignore crypto, real estate, gold, etc. Which of these would you choose? Well, while the stock market, it might rise and fall, it's more volatile than bonds. Because the return is so much higher, most of us are going to choose stocks. As a result, that pushes the price of stocks up. And that is why stock prices are so high today. But what if we change the return that bonds offer? Let's put this cup to one side. Well, if we increase the number to, let's say, 5%. Sure, it's still below the return of stocks, but stocks can rise or fall on any given year, whereas a solid bond over here offers you a risk-free rate of return. So in that example, money would likely flow out of stocks and back into bonds. So you see, the return that bonds offer investors plays a huge role in pricing stocks. So Buffett is making the point that stocks should be high today because bond yields or interest rates are so low. And this is backed up in some of the data too. This chart shows us the stock market earnings divided by the 10-year US Treasury yield. When the blue line is above the central line, it indicates the stocks might be overvalued compared to bonds. As we can see, around the dot-com bubble, this peaked around 70% overvalued. Today, however, even though stocks are so highly valued in their dollar value, well, compared to bonds, they can still be considered undervalued. This chart shows us the fair value of the stock market when factoring in bonds too. The red line represents the fair value, and the blue line is the real value. Well, as we can see, the data also backs up the idea that based on bond yields today, stocks are currently undervalued. Now, before we hear more from Warren Buffett, there is an obvious counter-argument to these points. The reason for the divergence between the stock market's fair value compared to bonds and the stock market's real value comes from the fact that investors do not think that interest rates will continue to remain so low indefinitely. As we know, the stock market is forward-looking. Investors are not so concerned with what's going on today as they are about what's to come in the future. And most investors are beginning to get more and more concerned about the threat of inflation looming. And for those who don't know, if inflation does grow too quickly, the likely response will be to raise interest rates. Will be to go from this cup over to this cup. Maybe not quite so extreme, but certainly raising that level. And that is ultimately going to impact the stock market in a negative way. So, with that said, let's hear Warren Buffett's thoughts on inflation.
We're seeing very substantial inflation. It's very interesting. I mean, we're raising prices. People are raising prices to us. And it's being accepted. I mean, it's not, if we get, well, take home building. I mean, the cost of, we've got 9 home builders and in addition to our manufactured housing thing. And then operation, which is the largest in the country. So we really do a lot of housing. The costs are just up. Steel costs, just every day they're going up, and there hasn't yet been, because the wage stuff follows. I mean, if the UAW writes a 3-year contract, we got a 3-year contract. But if you're buying steel at General Motors or someplace, you're paying more every day. So it's an economy really. It's red hot. I don't know exactly how when it shows up in different price indices, but there's more inflation going on than quite a bit more inflation going on than people would have anticipated just 6 months ago or thereabouts. We don't know what happens from the present policies. We do know, as Jay Powell said the other day, the idea that 100% of GDP was some terribly dangerous level for in terms of debt, and that doesn't really make a whole lot of sense now, and that used to be kind of accepted wisdom. We've learned that a lot of things we thought before weren't true, but what we haven't learned yet is whether what we're doing now is true. And the best thing to do is recognize you don't know and proceed in a way where you get a decent result no matter what happens, and that's what we try and do at Berkshire Hathaway. We do not think we can make money by making macroeconomic predictions. We do think we can be pretty darn sure we'll get a reasonable result under policies that will not maximize result if we could do that sort of thing.
So Buffett says that inflation has already arrived. It's come much sooner than he expected 6 months ago, and that the official data may not be showing inflation as accurately as it should be. It may be underestimating real inflation figures. Now, many investors see inflation as the #1 threat to the stock market today. Again, if inflation rises, interest rates will probably also rise. When that happens, the fair value of the stock market compared to bonds is going to fall. So, as investors, what can we do? Well, as Warren Buffett says, it's foolish to try to make investments based on macroeconomic predictions. While it's really tempting to do so because we all have a view on these things, as investors, we need to learn to be humble and admit to ourselves there are so many things we simply can't predict. That's why my personal strategy is simply to be well diversified across a mixture of innovation investments. These are my bets on the future, and they include things like crypto, Cathie Wood's ARK, and Scottish Mortgage Investment Trust as part of my UK ISA, a mix of passive investments across the world's largest stock markets, and some gold as a hedge against inflation. But I'm interested to know what you think. Do you think the stock market looks overvalued today or not? Do you think the big tech companies are due a correction, or do you agree with Warren Buffett that some are still undervalued? Let me know your thoughts in the comments below. Thank you for watching. I will see you again very soon.